What's up, guys? Welcome back to Everyday Money. We all know that saving your money and investing it for your future is a great idea, but for a lot of you out there, you haven't gotten started because you may not know what to do. You may be sitting there just like, I'm new! I don't know what to do! And we all start there. We don't know exactly what it is that we need to know or what we need to do, and you might get stuck in an analysis paralysis situation where you just don't feel like you know enough to make a good decision and take the risk to take some of that hard-earned money that you have and invest it into something for your future so that hopefully one day you can quit working and just live off of your investments. So what I've done is I've put together what I like to call the definitive guide to getting started in investing in index funds, but really this would go for any type of market investment that you may want to get into. So to get started, the first thing that you're going to want to do is you need to get yourself educated. Take like a week where you just read all that you can about investing in index funds, investing in stocks, investing in the stock market, the S&P 500, the Dow Jones, whatever it is that you are interested in investing in. And if you don't have any idea, just start with these market investments. Learn what a mutual fund is, learn what an index fund is, an ETF, learn about even things about individual stocks, PE ratios, 52-week highs and lows, moving averages, things of that nature. And there are a ton of great resources on the internet, 100% for free, that will not only educate you, but give you the confidence to invest your money into something that you think will grow over time with confidence, in that you won't be putting your money just, willy-nilly into investments that may or may not go up in value. A great place to start is right here on this channel. I'll put a playlist in a card that is all about investing in stocks and what an actual stock is, why the stock market always goes up, and what my recommendations are for investing in markets. In the short version of that is index funds such as VTSAX or VTI that have predictable results. But if you don't want to take my word for it, look at things such as the J.L. Collins stock series, and that is going to focus again on why stocks always go up over time, or the stock market always goes up over time, because stocks individually don't necessarily always go up. It goes into index fund investing, what happens during crashes, et cetera, et cetera. It's a great free read online. Google J.L. Collins stock series. Look at websites such as Mr. Money Mustache. That is a great resource for learning about index funds, learning about minimalism if you're into that. It's not my thing. Minimalism isn't my thing, so I don't get much out of them for that. But they have a ton of great stuff on investing in total market funds and just putting your money to work and watching that compound interest snowball exponentially so that your money grows at a faster rate over time, basically all the time. Check out Graham Steffens' YouTube channel. He's a fabulous content creator, and he has tons of information on investing in markets, investing in even like real estate and money management, things of that nature. Read a couple of books, The Millionaire Next Door, the Rich Dad Poor Dad series. Just read anything that you can about investing in the stock market and using your money to grow your wealth over time instead of just working day to day for a paycheck. If there's things that you see in there that they don't necessarily address, like they just gloss over it, and you want to know the information on a specific thing, you can even use resources such as Wikipedia and Investopedia to look up, like, for example, what a PE ratio is, or what an expense ratio is for a mutual fund or an index fund or a ETF. You can use those resources to look up the very specific items that may get glossed over in such as channels like mine, channels like Graham Stephan, the Minority Mindset channel, just anything like that. Now, the next thing that you all have to do is that you need to pick the platform or investment company that you are going to do your trades through. I recommend and use Vanguard. They're kind of the OGs of index fund investing, but there are several other financial institutions that offer low-cost index funds. And if you're already with one of these companies for other investments, it may be good to just stick with those folks and use the funds that they have, because a lot of them are similar. Like if you're looking for like a total market index fund, they should be very similar between like Vanguard, Fidelity, Schwab, etc. Just be sure to compare their trading fees, their expense ratios, and the ease of use of their website and their apps, because those are the ways that you are going to interact with those companies and buy and sell the funds that you want to get in and out of. I can tell you that Vanguard has a very easy to use app that I use almost all the time, just straight from my phone. I very rarely use their website, and the ease of use of things is about as big of a consideration as anything, because nothing frustrates me, and I'm sure all of you all, more than technology that doesn't work the way you want it. So once you guys have done your research on just what all these things mean, and you've picked a company or platform to use to make your trades, the third thing that you need to do is you need to figure out how you want your money to be invested as far as the tax status goes. And this is going to be if you want essentially your money in a taxable account or some sort of tax deferred account. And there's three big ways that this goes. You can have a taxable account, a traditional IRA, or a Roth IRA. They all have their advantages and disadvantages, so we'll just start off with the taxable account. This is where I actually keep a lot of my money that I invest outside of my work-sponsored retirement plan. And the reason for that is because it gives me the maximum amount of flexibility with the money. There are no restrictions on age and when I can take it out. There are no penalties to take money out. And this gives me the most freedom from the government telling me when I can use my money. The downside to that is that anything that is taken out is going to be taxed at capital gain rates. And if you hold it longer than a year, it will be taxed at short-term or long-term capital gains, which are a lot better than ordinary income tax rates. And if you keep your funds invested for less than a year, you end up getting taxed at short-term capital gains rate. Also, the dividends in a taxable account will be taxed, and that will depend on if they are qualified or non-qualified dividends. The difference there also being that the qualified dividends will be taxed at long-term capital gains rates, and the non-qualifieds will be at short-term capital gains rates. If you want to invest your money into a traditional IRA, this works like your typical 401k or whatever. You can contribute pre-tax if you're in like a work-sponsored retirement account type of deal, or you can deduct the contributions that you put into an individual IRA on your taxes. The benefit for this is that these funds grow tax-free. Your dividends and any reinvestments are not taxed until you take the money out. The problem with this is that those funds are locked down until you are 59 and a half years old, unless you want to pay taxes to take them out and a 10% penalty to withdraw those fees because you didn't pay tax on them when you earned that money. There are certain exceptions to this, such as college education, if you want to purchase a house. There are some circumstances where you can avoid that 10% withdrawal fee. You want to use this type of IRA if you expect to make less money in retirement. Because if you make less money in retirement, your tax rate should be lower based on the typical ordinary tax progressive tax structure. The third is the Roth IRA. And what you do there is you are able to contribute after tax dollars. So you've earned the money, you've paid the taxes on them, now you've invested them in these funds. And those funds grow tax-free until retirement. Again, those funds are locked up until you are 59 and a half years old for any gains. However, you can withdraw any contributions that you've made to a Roth IRA tax and penalty free because you've already paid the tax on those contributions before you put them in the Roth IRA. So that's a little bit of an advantage for the Roth IRA, but you will not be able to take out any growth earnings until you're 59 and a half without a penalty. So what this is good for is if you do plan on making more money in retirement than you did while you were working, it will allow you to take your money to grow tax-free and for you to withdraw it tax-free as well. Then the last thing you have to do is pick what investment that you want to make. Since we're talking about index funds, we're usually talking about what index that you would like to invest in. Would you want to be in a total market fund? Would you want to be in an S&P 500 fund? Do you want to invest in a specific sector, domestic, international, whatever? And you have to do the research on those. I can't tell you which one to use. I can recommend using a domestic total market fund if you are in the United States. This gives you broad diversification and allows you to purchase every listed equity in the U.S. stock market, so that if one company or sector gets, demolished, it won't take down your entire portfolio. But be sure when you're looking at these to make sure you look at the risk, look at any costs associated, any fees, trading fees. And if you are looking at a particular sector, be sure to do your research on that sector. Because, for example, if you invest in a tech index, and something happens, like something with Section 230 were to happen, that may very negatively affect the tech industry. And if you're completely invested in that, you could really be wiped out. Same thing with like energy. If there's a big crackdown on using fossil fuels, that could very negatively affect the energy sector. So just always be sure that you are doing your research, you know what you're getting into, so that you can mitigate as much risk as possible. And the more specific and the more niche that you get as far as your investments, the more that one thing can take down your entire portfolio, which is again why I like to invest in the total market, so that no one thing will likely be able to take out my entire portfolio. So once you've done all these things, the thing that you need to do now is sit back and wait for your money to grow. Be sure to put in as much money up front as you can, because time in the market beats timing the market every time. And the same thing with picking stocks. This is why I recommend investing in index funds. Picking stocks is not a reliable strategy for really anyone. Even the big millionaire Wall Street guys cannot reliably pick stocks and be able to beat the markets. That's why I always recommend index funds. But you need to have at least a 3 to 5 year time frame that you're looking at for any type of investment, because the market does go up all the time, but it doesn't necessarily go up every year. So if you have a 1 or 2 year outlook, you could lose money in that time. But a 3 to 5 year outlook horizon is probably pretty good. Just be sure that you can continue to put in as much money as you can every month or every payday or whatever, so that you can continue to grow the capital that you put in there can grow over time for you. Remember that money in the market typically doubles about every 7 years. So, if you just keep that in mind, you can ride out the roller coaster that will be ups and downs of investing in stocks, but knowing that you should receive that predictable 10% annual return over the long haul. So thanks for watching today, guys. If you like this video, be sure to smash the like button for me. That really helps out this video in the YouTube algorithm. Also, if you're not subscribed, go ahead and mash the subscribe button as well. That way you'll see all of my future content and content similar to this in your YouTube feed. I appreciate you guys watching today, and I'll see you in the next one.